Good morning, everybody, and welcome. Today, we're going to do something a little bit different, and we're going to be doing a bookkeeping boot camp. So we've got 5 days, 10 tasks to get everybody shipshape and up and ready with their books. So quite often, as accountants, we see accounts that are not up to date and not providing people with the best information available. So decisions are being made without being fully aware of their facts and figures. So what we thought we'd do this week is take a step back and look at how we get our books up to date. Quite often it's all horribly overwhelming, and you know you've got your account set up, you've got an accounting system, you've got piles of paperwork, you've got unreconciled bank transactions all over the place, and it just looks like a horrible job. You haven't got time to do it, you don't want to do it. You know, quite often you look at it and you think, no, it's just too much. So you leave it, and everybody leaves it till another day. So we thought what we'd do is a bit of a challenge here, and we've got 5 days for this week. We're going to cover 2 topics every day to get your books up to date. If you're a bookkeeper and your clients' books aren't up to date, you can work them through the same process. So we've got an account system. We've had it for months. We've not done an awful lot with it. We could have had it for years and we haven't done a lot with it. We often see that, don't we?
Yeah, it's not that rare. It does happen.
No. So where do we start? So first thing we look at is bank and cash. So I'm going to talk through bank and how we start processing our bank accounts and bringing those up to date. And Harry's going to talk through cash in a moment. So first things first. We're going to make sure that all of our bank accounts, we might have deposit accounts, we might have savings accounts, we might have multiple current accounts. We're going to make sure that each one of those has a feed into our accounting system. Then we're going to make sure that the accounting feed is up to date. It might not be posted, but it's up to date. So we're going to find all of our bank transactions, export them from the bank if we're doing a manual update, or import them if you're doing a system update. Now, one of the challenges with a system update is that quite often when you're trying to connect a new feed, the bank accounts in, say, Xero or QuickBooks will connect to that bank account feed, but will only pick up the last 90 days transactions. So if you have unimported, unreconciled transactions that are prior to that date, you have to go and manually collect those, download them in a CSV file, or I can't remember what the other one is. It's not QuickBooks, is it?
It's
QMP file, Quiv file,
yeah, something like that.
Quiv file, I think.
Something like that.
We'll have to have
it has a Q in it.
Yeah. We always use the CSV file because we find it makes a cleaner import. So go to your bank, download the CSV file, and then export that into a spreadsheet. Now, if you're going to import transactions into your bank and you're going to do it manually, one of the challenges with Xero is that you'll often bring the accounts down and they'll have a debit and a credit column for your transactions. But when you're bringing it into Xero reads a single line. So you have to add a third column with the single transactions in. So there will be negative outgoings, positive incomings. Add those into a different column, and then you import your spreadsheet into Xero. Now, once you've imported your spreadsheet into Xero, you do need to make sure that your bank transactions reconcile. And I would do this before you start posting. So make sure your starting point is correct, and make sure, because Xero will still look at the number of unreconciled transactions. So you can still do a bank reconciliation report, even if you haven't actually got the transactions reconciled. And what that helps you to identify is if your bank transactions are missing or if they're not reconciling at that point. If that's the case, you have to then work back month by month to find the first point where your actual bank reconciled. If that's at a point where your accounts have already been filed and your accountant's already done your accounts, then you need to go back to them and find out what those missing differences are. So that does make things a bit complicated. So let's assume we've got our transactions in Xero or QuickBooks. Now, QuickBooks doesn't care whether you have single column or double column. So if you download your transactions from the bank and, oops, that's my phone beeping. So if you download your transactions from the bank and they're in a double column format, that's fine. You can import them into QuickBooks. Xero, single file. So we're going to import them into QuickBooks or Xero. Then we're going to check to make sure that the opening balances are correct. We're going to check to make sure that our running balances are correct. So check your most recent reconciliation. You'll have a long list of unreconciled bank transactions, but that's fine. What we're trying to double check is that at the end of the day, we've captured all of our bank transactions. Now, when you've got your data in a spreadsheet, you can check the running balances. If your Excel skills are strong enough, you can check your running balances and make sure that your outgoings and your incomings all net off to the current account balance in your bank. So basically, you'll have reconciled it before you import it. So do that if your Excel skills are strong enough. If they're not, you can do that in Excel or QuickBooks. So what do we then do? We've got a whole ream of unreconciled bank transactions. Now, these can be quite overwhelming. So what we would recommend is work through them a month at a time. Get to the end of each month, do a quick reconciliation to make sure you haven't duplicated anything or missed anything, and then carry on. And there are some shortcuts to make your reconciliations easier. So, for example, one of the things we would often do is set up rules for repeating transactions. So if you've got bank fees, for example, which is a repeating transaction which generally doesn't have an invoice attached to it and doesn't have any VAT, just write a rule in your system so it's auto-posted. Then you know as that rule comes through, you can click OK, post that transaction and forget about it. We do the same for recurring US dollar transactions. So things like Dropbox or Zapier, that kind of thing, where they're billed without VAT, but you have to go and fetch the invoice online. Now, that's a bit of a pain and has no real value for VAT because there isn't any. So what we often do is have a rule for US dollar type subscriptions or memberships or lynda.com, things like that, and have them posted to a separate general ledger account, which is a US dollar software with no VAT, so that no VAT gets accidentally entered onto it. Post them directly. They kind of are what they say on the tin. They can't be anything else but Dropbox or lynda.com or Zapier, so just post them. You could go to the trouble and effort of getting the invoices, but how much value do they really add?
Plus the conversion rate also changes and the amount changes. So you've got to find the invoice, you've got to duplicate. It gets more complicated.
It does get to be quite a pain in the bum.
It doesn't add enough value to justify doing.
So for those ones, we would just write a straightforward rule. Now, then you've got things like loan repayments. They generally don't have an invoice attached to them, so they don't need to go through your purchase ledger, but they will have an interest repayment element and a capital repayment element. Now, the capital element needs to be posted to your balance sheet to reduce your liability to your lender, but your interest repayment needs to go to your P&L as a charge to your profit and loss account. So make sure you have the documentation for your loan agreements and calculate that at the onset so that your loan repayments are always calculated correctly. So that makes sure that the charge goes into your P&L each month, not in your balance sheet, so you're not overstating your loan repayments and you're not understating your charge to your profit and loss account. So that means that your management accounts are more likely to be accurate. Now, you'll often find that you've got payments to suppliers, but you won't necessarily know what invoices you've paid, and you may not always have those invoices in your system. They may be sitting in a pile somewhere, they may be sitting in an inbox somewhere, they may even been lost in the post. It happens. So what we would do in those instances is post all of those payments on account. So you end up with a series of overpayments on the supplier or creditor account. So whilst this isn't physically reconciling it to an invoice, what it does do is give you a chronological order in your debtors or your creditors of payments that are made to that particular supplier or from that particular customer in chronological order, which actually makes it far easier and more straightforward when it comes to trying to reconcile your accounts and trying to reconcile those transactions with your customers or your suppliers. It creates the beginning of a template that you can then reconcile.
Otherwise, you get one transaction on one page of your internet browser. You go to the next tab, you can't find it. You go to the next one, you find the second payment. Gets complicated.
Yeah.
Better have them all in one place and then know where you're working from.
Yeah, and so you post those as overpayments. Now, if you've got transactions that you have spent, or you've got them incoming or outgoing from your bank account, but you don't actually know what they are, what I would recommend is posting those to a queries account in your P&L. So you may not have accounted for the VAT yet, that doesn't matter. You can account for that when you get the invoice later. And you may not know exactly what it is. But from a management accounts perspective, that transaction's been accounted for and it's in your accounts as a query, not in the right place, not necessarily for the right value, but it's in your accounts and it's accounted for. So we would strongly recommend using a queries account and then reconciling that, checking that, reviewing that at the end of each month, however often. Now, we use that with almost all of our clients, and most of the queries accounts are teeny weeny by the time you get to the end of the year, with the exception of one or two people that are just too busy, they don't care.
Yeah, but it gives you the worst case scenario,
exactly,
though. So
exactly.
All that happens is if they do have a bigger queries account and they find a load of VAT invoices and you can repost them, you just save yourself some costs and you recover some VAT. It's always very handy.
And if you haven't, then you've at least accounted for those costs from corporation tax perspective. Now, if you find that one of those queries is a fraudulent transaction, you change the account code from a P&L cost account code to a balance sheet asset code called, you could call it queries fraudulent transaction. Put that somewhere where it's ring fenced and then chase the bank to get that refunded or clawed back. Now, because it's sitting in your balance sheet as an asset, it's something that is yours, it belongs to you, because you're going to get that money back. So you consider it to be an asset in the balance sheet. Now, one of the lovely things you can do with Xero is use a watch list to flag some of these accounts, the queries account, the things like your to be recovered accounts, your fraudulent transactions accounts, things like that. So anything that you want to then monitor and look at regularly, you can tag as a watch list account so that they pop up in your Xero dashboard. That's a really good idea. We use that quite a lot.
Really handy.
So that's where worked through some of our bank account transactions. Harry's going to talk through cash.
So cash in itself works in a similar concept to the way that the banking does. Only difference is you can't do a direct feed, and depending on how up to date your records are, this can be potentially a little bit of a problem, because essentially, if your cash book records are up to date, it makes your life a lot easier. If they're a bit out of date, then it's a little bit tricky to catch up. But the main thing on this one is that you need to include a running balance. Basically, if you have a cash account, you have all your transactions in it, you can see what you spent, you can see what you received, but you don't have a closing balance, it makes it a lot harder to reconcile. So I would say, if you have a cash book and you haven't got that record, add it in. If you don't have that record and you can't go back to it and basically calculate it and work it out, I would recommend getting your import ready and then using Excel to get a running balance so you've got an idea of whether it looks right. Essentially, if you've got negative cash, you're missing a transaction. If you've got way too much cash, then you're missing a cash withdrawal, you're missing spends. So they stand out like a sore thumb quite quickly. Now, the other thing that I will say with cash is whether you do petty cash or if you have till cash, it's really important to keep track of. Obviously, till cash can be significantly higher in terms of physical value, but this is why it's really important to keep records of what exactly is cash and what exactly is a physical bank transaction, and not to get the two muddled, which has separate records for cash and separate records for banks.
Yeah, so most people who have tills will have till records and might keep a float. So there should always be a closing balance at the end of each day.
Yeah. If you have a float, it makes it very, very easy, because you know roughly what you're aiming for every day as your starting point. So it makes it so much easier. So unlike with bank accounts, you won't be able to export any information from your physical banking provider. So you'll have to create this in an Excel format. which you can import. So CSV, or as mentioned, the file format, which we completely forgot the name of, but essentially
it's a QIF file.
I think it's QIF. That sounds about right.
See, we don't use it, so
no,
we always use
CSV. CSV does the job. So similar format to banking imports. So you need your date, you need your description, your references, and as mentioned with Xero, any values will need to be entered as a single column. So positives being money in, negatives being money out. But with QuickBooks, you have the option to do this as separate columns, and then you can either do it as a single column, or you can say, right, I want this column to be money out and this column to be money in. So entirely up to you how you do that. Now, the one thing I will say with actually doing cash records is there's a lot of temptation in the system to create the transactions, and then depending on how you do it in Xero QuickBooks, there's an option basically to tick it as manually reconciled. Now, I would always recommend importing from an Excel, well, a CSV file instead, because for the simple reason, if you accidentally delete the transaction, it's much harder to find out what you've deleted, how it affected your accounts, and where it went from. If you've imported the transaction, it will suddenly pop up on your banking feed and you'll see it's unreconciled and ready to resolve. So that's my personal recommendation. I think it's much easier that way.
Yeah, it's sort of a bit of personal preference, isn't it? So I've seen people who run petty cash accounts and till accounts from, they're in Xero or their accounting system so often that they just manage to get it up to date and it works.
Yeah.
Whereas others, they just don't, and it gets out of date and it gets out of sync. And you perhaps take £100 out of petty cash and it's gone. You think you'll update your accounting system later and you don't.
Yeah.
So it is so much easier to keep a paper record inside your till or inside your cash book, and then transfer that to an Excel record at the end of the month to make sure that everything reconciles, and then import to make sure that you've got that audit trail.
Yeah.
So yeah, I agree. That's the way I would do it.
And also QuickBooks especially, it's really useful because I'm not quite sure why, but at the moment in QuickBooks, whenever you edit a transaction, if it's currently posted without VAT, if you change its account code and it automatically defaults 20% VAT, if you've got the receipt marked as tax exclusive, it suddenly adds 20% to it.
Yeah.
Now, if you've manually marked this as reconciled, it's not going to flag in the same way. If it's an import, it locks it out a bit more, and it basically marks it as tax inclusive. So it's not going to push your balances out all of a sudden, because that is a bit of a fiddly.
I think it's a bit quicker as well, isn't it? If you make a mistake and post, because petty cash, despite being so small and seemingly insignificant, is often one where people make mistakes. So you'll post a payment and match it against the wrong transaction, or you'll match it against a credit card transaction. It's often easier to work from an imported set of statements, because then you can undo, redo and amend.
Exactly.
Whereas if you've manually created that transaction in Xero or QuickBooks, it's a bit more fiddly to reconcile, isn't it? So
now the other thing I will say also with cash is if you've also got anything like credit cards as well, or prepayment cards, similar concept, you might not be able to get a direct feed necessarily, but do this as an import in the same way you would. But what I would recommend with credit cards, prepayment cards, is if you've got multiple staff members who each have access to a card, I'd really recommend using the reference field as an additional column, because then you can identify exactly who has used the card for which transaction.
Yeah, because that's often on the statements, isn't it?
And sometimes if they get missed, it's tricky to identify, because you can say, all right, I know on this date this much was spent to this provider. You say, who spent it?
No
one knows. So that's why I would recommend having it. It makes it so much easier.
And you'd use the same debtor and creditor overpayments, wouldn't you? And,
exactly.
And queries accounts.
So it works on the same premise as the bank account. So if you've got transactions which are basically, like Lisa mentioned, where you're receiving customer receipts, but you don't necessarily know how they're allocated, etc., post them as a payment on account. And it means you've got a single record. And actually, this is really handy if you happen to have a supplier who you've paid in cash and in bank transactions, because before you would have these transactions scattered everywhere. Yeah, and in card as well. Otherwise, you get transactions scattered everywhere. You have no idea exactly what their records look like. But then if you have the payments from the bank, from the credit card, from the petty cash, all in a single place.
Yeah.
It makes it so much easier.
So that's actually quite common with people who, you know, building suppliers and people who are out and about quite a lot. So you'll get some payments on account, some payments in cash, some payments on card, depending on what they need for what particular job at that particular time. So it does make it a lot easier if you post all of those different cash sources, and then you'll find it's a lot easier to allocate and find those missing invoices.
Yeah, especially if you decided to give someone a £50 deposit in cash and then you paid the rest on card.
Yeah.
So it just depends. But that's my personal preference. And as mentioned with the queries account, I would do exactly the same premise. If you're not 100% sure what the actual item relates to, use a queries account. Then you've got all your accounting items in a single list. It makes it easier to work through. And as Lisa mentioned, it's more useful for your management accounts because you've got the worst case scenario in your profit and loss report rather than having a list of unreconciled transactions, which are, when they're eventually resolved, just wallop your P&L unexpectedly. So that's our personal recommendation on that.
Yeah.
It's so much better.
And one of the things that we see as accountants is, you know, everything's reconciled, or so we think, and then the client will come up with a whole load of receipts that they paid in cash at the end of the year. So they haven't claimed the VAT on them, they haven't put them through their account, so they've missed their costs. I mean, we can still adjust for them later, but they'll have overpaid their VAT at the time, or they'll have, you know, filed a set of accounts for the end of a year, and we didn't know there was, you know, £1,000 worth of cash payments back in, you know, goodness knows when from, you know, prior year. So it's really important to keep all of your cash and your card and your PayPal and all of those transactions up to date and fed into your accounts. Automate as much as possible. Most accounting systems will take direct bank fees from most banks and most credit cards. PayPal is a little bit trickier because if you're using it as a payment gateway and not to receive cash in, then the reporting isn't as intuitive. You have to download a balance affecting report from PayPal and import that directly. It won't directly bank feed into you. If you're receiving constant income into your PayPal account and it's always a positive balance, the bank feed is almost perfect. It works really, really well. So that's something else to watch out for. So this is our 22 minutes at 10 today. So this is day 1 of our bookkeeping bootcamp where we've covered bank and cash. We'll see you again tomorrow for day 2. Take care.
Bye.
Bye.